Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is August 2nd, 2022. And let's get right to our headlines of what's moving markets we're paying attention to, so you should be too. Thanks for watching. So our three things we're talking about today are peak inflation. Are we there? Earnings, corporate earnings updates, and ultimately the Fed's plan. Well, let's start with corporate earnings. Right now, we're in the middle of earnings season for the second quarter of 2022, and we're seeing better than expected. We saw it last week with big tech. We're continuing to see corporations, not all of them, but you're having the have and have-nots, the, as I call, operational excellence, and those that have operating leverage to either price elasticity, press on that good or service to the end consumer. And the consumers are strong, depending upon what market you're looking at, depending upon what sector of the economy, and depending upon where the demand is actually coming from. Now, obviously, there's the supply chain stuff, but there's also the pent-up demand that we're seeing from consumers. Ultimately, it's the execution of corporations and the ability to use technology in their balance sheets to optimize and execute on a real-time basis. So the earnings reports are showing us that, and we're seeing about 70% above beat on the expectation side, our earnings beat relative to the expectations, and earnings are coming in above 1.7% above higher, trending higher than what was originally expected in terms of a return. So we're looking at double-digit earnings right now for the S&P 500 on a whole. So we're tracking that. So earnings are coming in better than anticipated. That's why we saw the relief rally in end of July that we just saw right now play out. And we're going to see if it can hopefully continue as we see corporations navigate the recession that we're in. Also, is peak inflation here is a lot of questions. The Federal Reserve wants to know, all the economists are trying to prognosticate, they're trying to figure it out. But as I say in all the interviews that I've had from Bloomberg to Yahoo Finance recently, it's all about the kitchen table economics, what you and I spend our money on. And even the government's basket of goods and services, their CPI, Consumer Price Index, they basically say, hey, listen, we're going to buy a big screen TV every year, and that has to be factored in. So prices of TVs go down every year. The answer is no, we don't buy big screen TVs every single year. Technology goes down every single year. So that, and as a factor, as an anchor as to the factoring in, it's a flawed index. I hate to say it, but it is. What you and I spend money in, I spend money on education. That's a double-digit rate of return in terms of inflation every year from high school to college that I'm experiencing at Rob Schein and Jenica Schein's kitchen table, as well as energy. Energy is in everything that we do. So honestly, our inflation rate at our household is double-digit on average rate of return. So it's even higher than the 9%. But does it roll over? What's a process? And the Federal Reserve's targeting this. As they said, if you watch my previous videos, 6 months ago plus, the Federal Reserve started targeting by way of reversing policies. Even they started with talking before doing, and then most recently started changing policy by way of raising interest rates and QT, quantitative tightening. Ultimately, they're slowing and pumping the brakes in the economy. And they started with the stock and the bond market 6 months ago. We saw the bubble burst in the cryptocurrency market. Why that's relevant? Because it's $2 trillion that's sucked out of the economy. That impacts the slowing of the U.S. because you don't have that excess consumption, if you will, because those dollars aren't there anymore. Whether they spend them or not, it's that wealth effect, okay? And then finally, you're seeing real estate turnover. In fact, the headlines that we just saw recently is pending home sales fall 8.6% in June. And so the Fed's plan is to attack the third bubble, if you will, and their perception to slow down the economy because the economy is roaring. How do we know that? Well, let's go to the jobs market, the jobs report. So we have the JOLTS report, and that's the job opening. Number of jobs in the U.S. economy that are open right now, or corporations that are looking, there's 10.7, almost 11 million job openings right now. For every 5.9, so every 5 million unemployed. That's a 3.6, 3.7% print on the unemployment number. That's phenomenal. It's another low, if you will. So the job market extremely tight because you have 2 job openings for 1 job, somebody who's looking for a job right now. And that's how you read that. So the Fed is targeting this, and what they're trying to do is target the JOLTS by way of slowing the economy, by way of increasing the borrowing costs, increasing more uncertainty for corporations and CEOs. And that's what we're seeing in the earnings reports. More and more CEOs are coming out with the CEO optimism fading. That's actually an index that we're following, and it's coming way down. So what happens is when CEOs don't have a clear picture of the future, they freeze hiring and they start firing. And that's what's going to happen here. You're going to have this number is going to go down. And when this number goes down, this number will go up. And that's where we're going to get the equilibrium of the employment market. And that's what needs to happen between wages, job expectations. So corporations, CEOs, optimism is fading. Therefore, we're going to see this imbalance come back to balance. That's a Fed's plan, but on a whole, on majority, corporations are able, some of those corporations, better than others, able to weather the storm. And that's what we're seeing right now as we're in this recession. So that's our update for today. Thanks for watching, and we'll see you again next time.